What's up, everybody? Monday, December 9th. Got some sad news to report today. Former Fed Chairman Paul Volker died. He was 92 years old. Volker was considered a god among central bankers. He was chairman of the Federal Reserve from, I think, August 1979 until July 1987. And he's known as the guy who broke the back of inflation by jacking interest rates up really high, actually up to 21%. I think he raised the discount rate at the time in 1980 or 81 to 14%, but market rates went over 20%. Now, this is a big, and by the way, I'm going to do a separate video on Paul Volker so I can highlight, I'm going to show you graphics, and they're really very eye-opening, very incredible graphics. When you plot the data of the Fed's rate increases in the 1970s culminating up to 1980 or 81 when rates spiked up over 20%, 21%, the inflation rate went up lockstep with those rate increases. And by the way, just to be fair to Volker, his predecessor, Arthur Burns, he started the rate increases in the 70s. And I know, yes, we had 2 oil embargoes in the 70s. They were spikes, and they contributed to the inflation rate. But it's really incredible because when you plot the Fed rate increases against the inflation rate, I mean, it's literally one line right on top of another. And this is where, and this is an ongoing fallacy or misconception, that rate increases squash inflation. They don't. They add to inflation. Rate increases equate to price increases because the cost of credit is reflected in the cost of all goods and services. I've said this so many times. And vice versa. Rate cuts equate to price cuts. That's why you could look at countries like Japan, that 0% interest rates, negative rates even, for years and years and years, and they're like, we can't stoke any inflation. Or in the Eurozone, same thing with the ECB with 0 rates or negative inflation. And even here, you saw from the end of 2015 in December 2015, when the Fed initially reversed course on their interest rate policy and they started to raise rates. And if you use gold as a barometer for inflation, it went from $1,043 an ounce all the way up to what was the recent high? I mean, 1,500, and the Fed started cutting rates and gold has come down. But yeah, I mean, I'll do a special video on Paul Volker and the policies of the 1970s, the monetary policies of the 1970s, and you can decide for yourself. I'm going to make I'm going to put the graphics up there. I'm going to put the data up there so you can see it for yourself. You make up your own mind. But I mean, it's very clear, and MMT explains this very concisely. When the Fed raises rates, that's a general rise in the price level, because the cost of credit is reflected in the cost of everything. All right, enough on that. Just let it be known that Paul Volker is gone. Tall Paul, I think the guy was like 6'8". He was a giant among central bankers, literally and figuratively. So, what's going on? We have, we have a Fed meeting. Speaking of the Fed, we have a Fed meeting this week. Wednesday, no rate cut is expected, and the Fed is probably going to say it's comfortable with the level of rates where they are. Looking for a market pullback here. By the way, the banking data in my report today, and yeah, I should mention that today is Monday, so the new issue of MMT Trader has been sent out. If you want to get a copy of that, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. Remember, I'm the only one who does this. I'm the only one with an applied approach to MMT. I take the concepts of MMT and I apply them to trading and investing. Nobody else does this. There are a lot of MMT academics out there, and they talk about MMT theory and all the understandings of MMT, but they are not traders. I do this, and it's a service that I provide. So go to my website, pitbulleconomics.com, sign up for a 30-day free trial. The banking data in the most recent release of the Fed's H8 report, very strong, very strong. Loans and leases expanded at the fastest pace in 8 months. Real estate loans rose the most in 58 months in the latest week. 58 months. Commercial and industrial loans bounced back. They rose for the first time in 3 weeks. I mean, all across the board in that segment of loans and leases and bank credit, extremely strong. And once again, another big increase in bank deposits. I mean, that is a function of loan growth and wage growth. It is also a function of very rapid government spending, right? Government spending equates to income to the non-government. When the government spends more than it takes away in taxes, somebody, some entity is receiving those dollars, and that is the non-government. So very strong credit demand, very, very strong credit demand. Again, this is, we saw the job report on Friday up 266K. That was the high, that was the biggest increase in payrolls since January. So you have that. You have credit demand accelerating, in some cases growing almost, at the fastest pace in 7 years. You have, in 5 years. You have, what else? Copper prices at 5-month highs. A lot of indicators here. And we don't see indicators of weakness, we see indicators of strength. And I'm telling you, since the Fed now is on pause with any further rate cuts, because I submit that those rate cuts in the second quarter and the third quarter, they were a factor in slowing down the rate of growth of GDP. And now it's picking up. So yeah, it was really, really strong. You need to get that, my report, read about it, look at the numbers. I mean, the numbers are going to blow you away. There's nothing in those numbers that suggests any kind of weakness. Now, that doesn't mean we can't get a pullback based on monetary factors. All right, I talk about bank reserves up now at the highest level in 8 months because of the Fed's actions that they have taken recently in adding reserves and adding reserves. Now, they've taken reserves well above the early September period. And if you remember, and I spoke about this at the time, they said, well, we're just going to target reserves around that level. That's all we need to do to anchor our rate. Well, apparently that wasn't all they needed to do. They needed to go much higher. So reserve balances now are about 140 billion above where they were in early September. The rate, their target rate is anchored, but they have, and they might overshoot. I mean, they definitely overshot when they were bringing reserves down. Somebody was asleep at the wheel. Because basically they brought reserves down below the threshold of deposits. You have to have that 10 to 1 ratio, 1 to 10 ratio. So somebody was asleep at the wheel there. So they had a reverse course. Anyway, all this stuff is in my report as usual. You learn a lot. You get the right information. You get the mental game, you get recommendations, you get everything you need. So go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. And today, rest in peace, Paul. Tall Paul is gone. He broke the back of inflation. But that's what everybody remembers him for. But in fact, he was one of the factors that drove the inflation rate way up in the late 70s and the early 80s. And we can't let his predecessor, Arthur Burns, get off the hook either because he started the whole thing. I mean, Volker came in there kind of late. And as soon as they stopped hiking rates, guess what happened? Inflation fell. And you see this all over. Look what happened in Turkey. I told you about, Erdogan, the president, who's not an economist. He understands economics. And by the way, MMT economics, or the way MMT would describe it, better than all of his, former central bankers who he thankfully got rid of. But he said, hey, if you cut the rate, inflation's going to come down and the currency will appreciate. Well, guess what? He cut the rate, or he had a new guy cut the rate. Inflation came down. Same thing in Mexico. They cut rates and now it's like, hey, inflation is coming down. Gee, who would have guessed it? I would have. All right, everybody. Go to my website, pitbulleconomics.com. Sign up. Bye.